Hello everyone, welcome to Demand Supply Trading Practical Session number 1 for the year 2025. Myself, Srijit Kakkar, and today is Saturday, 4th of January 2024. Wishing you all a very happy and prosperous new year. Now, before we get started, let's get done with the basic formalities. So, make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you regarding these sessions. If we have any, let's say, promotions coming up, or if there are any, inputs regarding demand supply methodology. So, if you wish to join this Telegram channel, you can scan the QR code which is available on your screen. The direct link is also available in the description. You can also check the description, click on the link, and you can join it. And the last way is you can come to our website, and on our website, on any page, once you scroll down to the footer, you will see you'll have the option join Telegram channel. This is also where you can click and you can join the Telegram channel. So these are a few different ways using which you can join the Telegram channel to be updated regarding these sessions, or if you have any promotions coming up, or if we have anything to add to demand supply methodology. So we keep posting on that channel. All right, so yes, like I already told you, you can go to our website. What are the URLs for our website? We have two links available to you. The first one is surjitkakkar.com. That's our primary website. But yes, if you need a short URL, you can go to sk.coach. This will redirect you to surjitkakkar.com. And these will come handy as we move forward. We'll talk about some courses which are absolutely free, 100% free courses. We'll talk about some documents, we'll talk about some indicators. So this is where you'll be able to access all of them. Now, talking about practical session of, today's session, that will be practical application of demand supply methodology. Now, if you have already gone through our course, good enough. That basically covers our strategy, what demand supply is all about. But I know some of you might be joining for the very first time. So we will be going through the process, how you can access the course, and what are the prerequisites for these practical sessions. Now, talking about the prerequisites, the first one is the Trading Essentials course. Now, it says optional. Now, why it is optional? Because those of you who are not joining as a fresher, who already have good enough experience with the markets, you probably understand the terminologies we use. So that is where Trading Essentials would be optional. But if you are someone who's starting as a fresher, then it is not optional for you. So how can you take the Trading Essentials course? Very simple. Once you come to our website, you can go under services. Here you can see we have our courses listed. So just click on courses. And as you scroll down, you will see you have your Trading Essentials course. Click on get started. And now you'll have the course available in both the languages, English as well as in Hindi. Whichever language you're comfortable with, you can click on that and you can take the complete course. Now, once you're done with the Trading Essentials course, then you can start with the Demand Supply Trading Methodology course, and this is where it is available. You can again click on Get Started, and you will see that you'll have links to the English sessions, the Hindi sessions. So that's your theory part, the complete methodology in English, the complete methodology in Hindi. And you also have access to the recordings of the YouTube live sessions. So these live sessions that I do, we keep adding them to a playlist so that if you want to access the complete thing at one place, you can simply click on it. You can also go through the recordings of the previous sessions as well, right? So those are the two courses which are your prerequisites. So make sure you go through these courses. The first one is definitely optional, but second one, you'll have to go through that course to learn the complete demand supply methodology. Now, once you know the methodology, the next thing is you will be attending these practical sessions, or even if not these practical sessions, you will be doing your analysis by yourself. And for the analysis part, we have created two documents for you. One is the rule book and the other one is the flowchart. And you will see me using these documents in every session for planning the trade, because that is what makes our approach mechanical and rule based. So how do we access these documents as well? Very simple. Again, once you're on our website and the services, you can see we have downloads. Click on downloads and you will be on this page. You can see I have the rule book and the flowchart. So simply click on download and you will see I'll have both the documents now. We have the rule book and we have the walkthrough. Right now on the walkthrough or the flowchart, you can see that some of these texts, they have a link in front of them, which means if you click on these links, they will take you to some pages. Like this will take you to our website. Similarly, we have two scanners which are purely based on demand supply methodology. So you have the link to them as well. You also have the link to the demand and supply zone indicator. So as we move forward, we'll talk about them. But let's get started now. So like I was saying, that today's session is practical application of demand supply methodology, and I always say that trading has to be a very mechanical and rule based approach, and these two documents, they help you planning trades in a very mechanical and rule based way. Now, how you access those documents, I've just explained to you. So once you have these documents, you're ready to move step by step. So what is our step number one whenever we start planning our trade? Step number one is defining our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies what is going to be the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be the stop loss, the exit can be break even, the exit can. Okay, so I guess we have talked about all of them, right? So the exit can be the target, it can be the stop loss, it can be break even, and what else? It can also be the trailing stop loss, right? It can also be a trailing stop loss. So yes, it can be any kind of exit, but now the question is, why are we starting with the trade purpose as our step number one? And the reason for that is, when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? And for this, again, we go with a very logical approach, and that approach is, the longer the duration of the trade, the bigger the time frame we should be using for our analysis. And similarly, the smaller the duration for the trade, the smaller the time frame we should be using for our analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, if you're trading markets which are not 24-hour markets, then my recommendation would be, initially, hourlies and dailies should be done as strictly intraday trades, because when you're keeping your positions overnight, there is a risk of having a gap against you. And if you get a gap against you, you can lose more than what you were willing to lose on that trade. So that is why your hourlies and dailies will be intraday trades. Weekly monthlies, we have no choices, but we'll have to keep them as overnight trades. But that does not mean for weekly monthlies we cannot have gap against us. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. So yes, step one is we need to define our trade purpose, and let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, now I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We've already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my these 4 different time frames? And we get the answer from this table. Like in this example, I opted, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Intermediate will be weekly, used for trend analysis. Lower time frame will be daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart. Now, minded, this table, which is on page number 31, is specifically for the NSE market, because this market is open for a very short duration, which is like 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, then you can refer to the table which is on page number 32. But here we will be taking examples from NSE. Therefore, I'll be referring to this particular table. So yes, as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using. In this case, monthly, weekly, daily, and 60. and what analysis I'll be doing on each and every time frame. I also have the clarity to it. So my challenge number one is taken care. Now the next challenge is, yes, I do know my time frames, but there are approximately 2000. In fact, yesterday I updated my list. So yesterday I got a list of around 2500 plus symbols from NSE, right? So currently we have over 2500 symbols that get traded in on NSE. So it's humanly not possible that every day we sit and analyze 2500 companies. So what we need to do now is we need to have a process in place for shortlisting symbols. For this, there are a number of scanners which are available in the market, which are based on conventional technical analysis. You wish to use them, you can use them. Otherwise, if you want to shortlist purely based on demand supply methodology, then we have two custom built tools available to you. The first one is your demand supply zone alerts for TradingView, and the other one is demand supply zone screener for TradingView. You can definitely click on these links. They will take you to our website, to the pages of these indicator where you can find more details about it. But based on the feedback which I got from you people the previous year, is that we can save a lot of time if we skip through some of these steps, because they are not related to the analysis part, right? They're just giving you an overview of what those tools are. So that is what we'll be doing. We will be briefly talking about how you can access these tools, and on the website page you'll be able to find more information about it, right? So you can use a number of tools for shortlisting. Process can be as simple as, I just want to analyze my Nifty 50 stocks, or I have my own favorite list of symbols which I want to analyze. So whatever is your preferred method, use that method, get a smaller list for you. But very, very important, remember, all these tools that I'm talking about, scanner screeners I'm talking about, they are not call giving or tip giving services. They do not tell you what you need to buy or sell. They only help you in shortlisting symbols. Once you have a list of symbols, then you'll have to go through those symbols one by one and see which one matches with your trade plan. The one that matches with your trade plan is an opportunity for you. The one that doesn't match with your trade plan, you simply skip it. So let's assume we got a list of symbols, and we are starting with the very first one. Let's assume the first one was ABC. So what am I supposed to do next? On ABC, I need to go to the lower time frame. So now the question is, what is my lower time frame? And we got the answer from our step number one, that as a monthly income trader, my lower time frame is daily. So we'll go to the daily time frame to identify zone, and for identifying zone, we can use the demand supply zone indicator. Now the best part is that sometime back we started with 7 days free trial of our demand supply zone indicator. So if you have still not taken the trial and you wish to do it, it's very simple. You can simply just click on this as well. Can you see if I just click on it? It will take me to the indicator page, and that is where you can click on 7 days trials. You can click on 7 days trial and you can take a free trial of the indicator and you can try it out. So let's get back. Perfect. So yes, let's assume, like I said, the very first symbol was ABC. So we need to go to the lower time frame on ABC and identify zone. So let's assume this was ABC, and I'm already on the lower time frame. I already have the demand supply zone indicator applied, so I don't even have to identify the zones. The indicator is automatically doing it for me. So here you can see we have a based rally structure which the indicator has identified for us. So my step number 3 is now complete, which was identify zone on the lower time frame. Now, once you have identified the zone, does not mean we can trade it blindly. The next step is to qualify the zone, for which we have a 2-step process. In step 1, we'll qualify based on certain conditions, and after that, we'll qualify based on the booster scoring. So let's look at these conditions. The very first one is this zone a case of level on top of level? Now, what do we mean by level on top of level? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level. But if we don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, the beauty of this indicator is that you can, set your higher time frame, intermediate time frame, and refining time frame in the settings. Like here, you can see I've given my higher time frame as monthly, intermediate as weekly, and the refining as 60, and then you can click on automatic settings, so that whenever you're changing between these time frames, the applicable settings, like for the higher time frame we need all zones and curve, for the intermediate we need all zones and zone violations, they get applied automatically, so you don't have to manually change these settings over and over again. So now if I go to the intermediate time frame, which is weekly, let's see, do we have a zone? Where we have a zone here, the fact is we don't have any demand zone here. The demand zone on the intermediate time frame is here. So my lower time frame zone, which is the one in green, does not coincide with any intermediate time frame zone, and if it is not coinciding, it cannot be a case of level on top of level. So yes, we were looking at level on top of level, not applicable. Next, is this zone because of a gap? The answer is no, this is not because of a gap, therefore gap rules will also not apply. The next one is pivot and non-authenticity. Now, pivot and non-authenticity we only apply to drop-based rallies and rally-based drops. Currently, we have a rally-based rally structure to which pivot non-authenticity would not be applicable. So, level on top of level was not applicable, gap was not applicable, pivot non-authenticity is not applicable, and unstable equilibrium is also not applicable, because you can see that in this case, just give me a second. In this case, the leg out is not going below the basing. If the leg out was going below the basing, then we would have called it as a case of unstable equilibrium, but that's not the case for this particular example. So none of these conditions are getting applied, right? So if none of these conditions are getting applied, they cannot disqualify the zone. To disqualify the zone, first they need to be applicable, then it might be qualified, it might not be qualified, right? But if these conditions are not getting applied, they cannot disqualify the zone. So after applying the applicable conditions, none of the conditions were applicable. Is the zone qualified? The answer is yes. So now that we have a qualified zone, we can move on to the next step, which is the booster scoring. So let's do that. We'll start with the quality boosters. So give me a minute. Let's bring up the booster sheet. So the very first one is freshness. The zone is definitely fresh, and that is why the indicator is also marking it in a green color. Tested zones, they are marked in cyan color. Those are the default settings. You can definitely make the changes as per your preference, but this is definitely a fresh zone, and a fresh zone gets a score of 3. Talking about strength, you can see currently the indicator is also identifying follow-through patterns. So what I can do is I can say I don't want to identify follow-through patterns. I only want zones with explosive moves. So you can see this is not a zone with an explosive move, because when I change it to explosive, this is not explosive, right? But if I keep it as good and follow-through pattern, then you can see we have a nice continuation of that move, which means for strength, I can give it a score of 1, but not a score of 2, since it was not an explosive move. Next, time at the zone, we have only one candle in the basing, gets a score of 2, and reward to risk ratio will be taking as an assumption, therefore a score of 3. So if you talk about the quality factor, we have a score of 9 out of 10, which makes it as a high quality zone. Now talking about probability, the first thing we'll check is the location. Now if I go to the monthly chart, which is going to be the higher time frame, and that is where we do our curve analysis. So what you can see is that on this particular chart, we don't have any demand areas, we don't have any supply areas, right? The reason is because none of these structures are matching with the structures of a demand or a supply zone. And since we don't have any structures of demand supply area, the indicator is not going to mark anything for us. So now what do we do in such case, right? So that is why I took it as an example. Now there are two options available. Option number 1, if I don't have any demand supply zones to mark my curve analysis, I can't do my analysis completely. And in that case, the easiest option is I can skip this symbol and I can say, okay, this does not match with my trade plan. Let me look at another symbol and see what is available to me, right? So that's the very simplest approach. The second approach, which we have talked about many times in the past sessions, is that if you don't have demand or supply areas, but logically we understand that if you look at the most recent pivot highs and pivot lows, can you see this was the most recent pivot low, and that is where prices just started moving up. And this was the most recent pivot high, that is where prices just started moving down. So technically there has to be supply somewhere around here, that is the only reason for prices to move down, and there has to be some demand somewhere around here, and that is the only reason for prices to move up. Now the only fact that we see here is that those demand supply zones did not form on the monthly time frame, but I'm pretty sure on some smaller time frames we will be able to spot them. So what we can do is we can use these two areas as the reference point, and by using them as a reference point, we can do our curve analysis. And now we'll not be having 5 divisions, we'll be having 3 divisions, which is low of the curve, middle of the curve, and high of the curve. So in a way, I was still able to do my curve analysis, but with a small little tweak. Now, like I was talking about, it's just that I'm not able to see those demand and supply areas on the monthly, but if I start scrolling through some smaller time frames, you will see that somewhere around here we might be able to find some areas of demand and supply. Can you see we had an area of demand? That is where we got this reaction from. Now, even if I talk about supply, you can see we had supply a little higher, but if I start going to some smaller time frames, we might even see some formation of demand and supply areas somewhere around these locations. So let's do that because they might not be quality. So here you can see we have our demand zone exactly where our curve low of the curve is starting from. For supply, we don't have it yet, but if I go to maybe even a smaller time frame, I might be able to find something there. So here you can see we had an area of supply. That is where we tested, and then we started moving down. So if you think about in terms of logic, yes, there had to be an area of demand or an area of supply somewhere around these points, and that could be the only reason for prices to move down or for the prices to move up. So that is why this is a way around that. If you don't find areas of demand and supply, you can refer to these most recent pivot highs, pivot lows to do your curve analysis. And like I said, that is the reason I took this as an example, because in the past we have taken examples where we had, let's say, demand, but we did not have supply. But in this case, both demand and supply are missing. So again, two options. You can simply skip the symbol, move to another symbol because you don't have the required information to do your complete analysis, or you can have an alternate way, which is again logical, and you can see we just applied that, and based on that we were able to do our curve analysis. So based on our curve analysis, you can see our lower time frame zone is basically falling into two different locations, which is middle of the curve and partially also low of the curve. So now this is where again a challenge comes in. That challenge is that since it is overlapping between two locations, should I consider it as middle of the curve or should I consider it as low of the curve? Now the confusion will be resolved in just a few seconds, because if you think about it, what are we trying to understand? We are trying to understand that when we are entering the trade, where are we located, not when we are getting stopped out. So we always define our location based on where our entry point is, right? So entry point is lying middle of the curve. So we will be calling it as middle of the curve location. So let me remove this because it has served its purpose. So we are planning our trade middle of the curve, which is going to be a score of 0. If you talk about the trend, you can see the zone violation since it has been set to auto. You can see here it has been set to auto. Whenever we come to weekly time frame, it is automatically doing the zone violations, and it is telling me there has been violation of two supply areas, which means prices are violating supplies and making highs, which probably means I can be in an uptrend. So uptrend will get a score of 0.5 because we are middle of the curve. Next is move from the zone. We need minimum 4:1 move. Let's see, did we have a 4:1 move before the prices started coming back to our zone? So you can see we have 1:1, 2:1, 3:1, a little over 4:1, but not an exact 4:1. So the prices, they go up and then start coming back. Yes, we can upgrade to a score of 2, but currently this will remain as 0. Now, this is not a case of level on top of level. We have already verified that. It's not even coinciding. And the last one is trap. So if I take a horizontal line wherever the proximal is and just start pushing it up, you can see this area definitely looks really nice and neat. You can see in the past it has acted like resistance. Here it has acted like support. Here it has acted like almost resistance. If I bring in more history, you can see in the past it has also acted like demand, but there have been quite a few whipsaws as well. So not very clean, but we still have something which has worked like support resistance in the past. And now people who believe in support resistance, in fact, you can see very recently also, a few days back, it definitely worked like support. So people who believe in support resistance, what they'll be doing is, because they believe this should act like support, that is where they'll be buying, and their stop losses will be placed below this area, which will be sell orders. And similarly, if you get a breakout, then people who believe in breakout will also start selling. So by the time we start getting into this area of demand, we know people who were already long, their stop losses will start getting hit, plus people who believe in breakout, they'll also start selling. So a lot of selling will start coming into the market. And these people are making two novice mistake. Mistake number one, they are selling after a decline in price, which means they are selling at a cheaper price. And mistake number two, selling in an area where the chart has proven to us that back in history, demand was more than supply, which could be the only reason for prices to move up. So yes, that possibility is there that this might work like an area of trap, for which we will give it a score of 1. So if you look at the overall scoring, we do have a high quality zone, but the probability is not really high. It's a low probability setup. Therefore, it should only be done as a type 2 or a type 3 trade. And plus, even if we get a 4:1 move, this will still be a 3.5. So no matter what, it cannot get converted into a type 1 trade. This will remain as a type 2 or a type 3 trade for us. So going back to our, just give me a second. Right, so going back to our flow chart, yes, we did the boosters, and after applying the boosters, we got to know that this should be a type 2 or a type 3 trade. Next, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade, for which we need to do proper position size calculation, so that in case the trade doesn't go in our favor, it goes against us. We should not lose more than what our risk management rule allows us to lose. Next, whenever the prices are back, you'll have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before entering a trade, you'll have to re-verify, does it still match with my trade plan? And if yes, it qualifies based on your trade plan, then you place your order based on the entry type. In this case, it's a type 2 or a type 3 trade. And once your order has been executed, the last step will be your trade management, where 1:1 will make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we'll start trailing onto it, unless and until we get an exit on that trade. So that is how we plan trades. Very mechanically, very rule based. And I also did a review of all the examples that I shared with you, which was the last session of 2024. So in case you have not gone through that session, do go through that session. That will definitely help you build your confidence in demand supply methodology. And the best part of these sessions are, you can see I'm always pre-planning the examples in advance, and later the prices, they revisit these areas of demand and supply. And through that review session, you will see how beautifully this worked out for us. And during that review, I definitely forgot to add one thing, that my limitation is I'm only sharing long trades with you. If I was also sharing short trades, the results could have been even better. But still, the results are not bad. They are amazing results. So if you've not gone through that video, do make sure you do that. All right. Now, at the end of the session, I'll definitely go through some questions, queries. But now we'll keep them really, really short. So I'll not be going through all the questions. I'll be going through few questions. And before I do that, I would also like to add that yes, during these sessions, I definitely go through your questions, queries, but there have been a lot of messages we have been getting from you people. Even during the live sessions, I get those messages from you people that during these sessions I can't review your trades, right? So if you people want that I should be reviewing your trades, or there are some questions, queries which you have and you personally want to talk about it, so we have started with a new option which is called as 1-to-1. So by coming to our website, you can click on 1-to-1, and that is where you can book a 1-to-1 appointment with me. So as you scroll down, or you can also click here, book now, and it will take you to this form, and this is where you can select your appointment, and you can have a 1-to-1 appointment where it can be a voice call. It can also be an online meeting where you can also share your screen and I can review your trades as well. So that option is also now available. Perfect. So let's see what we have in the chat box. Sometimes in the daily time frame, a leg out candle doesn't look strong and the move from the zone is also not strong, but the indicator identifies it as explosive and the strongest one. See, for this, we'll have to look into it. Unless and until I have an example in front of me, I'll not be able to answer it correctly. So what you can do is, Satish, whenever you see such an instance where you believe that this should not be marked as a leg out and the indicator has marked it, you can take a screenshot and you can send it to info@surjitkakkar.com. So you can email it to us and we'll definitely look into it. And if we feel, okay, there is some tweaks that needs to be done to our indicator, we'll definitely do that. But yes, for that, just simply take a screenshot and email it to us. Indicator is identifying it this way. So the indicator is identifying this way means, okay, so probably you mean is because these two are also boring candles, why the indicator is not taking them as boring candles, because you need to understand that demand supply is not based on boring, exciting technique, right? Demand supply is basically designed based on price action. Boring, exciting is something we start with to start training our eyes how to spot these structures. So that is the reason. If you look at the size of this candle, can you see it's a very strong and a candle which is not a narrow range, it's a pretty big range candle. So indicator is taking it as a leg in, not as a basing candle, because it is based on price action. We moved up, we paused, and then we started moving up, right? So remember, the indicator is not based on boring, exciting technique. It is purely based on price action. All right. If I'm taking a demand zone HIT trade and it is low on the curve on DIT but high in the curve on WIT, if considering HIT and DIT, should I it take it but not see, again, this completely depends person to person. Now, if I talk about myself, I would never take such a trade because I know that on the weekly I'm not placed really good, right? But again, if you think about it, even if you're in a weekly area, price might go a little deeper, where an HIT might give you an opportunity to quickly get your 2:1 before it starts moving down. So it will completely depend upon how conservatively or aggressively you want to plan trades. Again, if I talk about myself, I would never take such a trade, but yes, it might still give you an opportunity where the prices are probably going a little deeper into the zone, which as an HIT trader can give you your 2:1 or whatever your target is before it starts moving down. So you'll have to decide based on your experience, based on your personality style, whether you would like to take such trades or not. But yes, overall, it will be a low probability setup because of those bigger time frames where you are located. How to trade news. A few days ago, I traded a good supply zone this and suffered a loss, even though the trade was DIT with all. See, again, this is something which we have already covered in our rule book. If you go into the rule book, just give me a second. And here it is. Can you see, when you know there are some key events, the first thing is you should always avoid HITs and DITs, because HIT, DITs, you're leaning against very small time frames, and because of the news, it can go against you really, really bad. So ideally, if you know there are some newses, at WIT, I'll say still a little on the aggressive side, but MIT is still acceptable. So WIT, MITs will make more sense. And then there are a few other things which are also available, and these are the things which you can keep at the back of your mind when you know you have some key events to safeguard yourself. All right. What is the reason for the follow through pattern and why it is considered in the zone marking? Do you use it? Absolutely, yes, I do use it. In fact, if you go through the review which we did the last session, you will see there will be so many zones which were based on follow through pattern. Because if you think about it, now if I just go back to the chart. Now, if you think about it, currently I'm using a daily chart. What if I was using a 2-day chart? Can you see, if I was using a 2-day chart, probably these two candles might combine together and make a bigger move, right? So that is the reason that, you know, those two small, I mean, not small, still good enough size candles can combine together to bigger candle, though this did not happen in this case. But yes, there can be cases where probably you'll see those two candles, they combine together to, you know, even a better candle, and that is what you get. Now, just as an example, can you see, if this is an explosive candle, probably if I had a 125-minute chart, let me just see it as an example. Let's say, if, you know, I'm just marking this area. Can you see, if I go to 125, or it is going to be 175, I guess 175. So if I want to convert, no, it will not be. So what I need to do now is, we have, let's do the calculation. So we have 6 hours, 6 into 60, oops, 6 into 60, and plus we have another 15 minutes. I want this to, you know, divide it into 2. So if I divide this by 2, we get 187.5. So I can't do 187.5, let's say 187. So if I go to 187 minutes chart, so okay, 187 will not work. So probably if I go to 175, okay, let's see, 175. You know, I'm just trying to see where I can convert this particular one candle into multiple candles. So that is what I'm talking about, right? So maybe if I just go to a 60-minute. Okay, so this was a pretty big move even on a 60-minute chart. So if I go to 15, yeah, perfect. So now just as an example, can you see here we have these multiple candles, and those multiple candles on a bigger time frame, they combine to a single really nice strong move, right? So that is the idea behind when you're looking at these two candles which are giving a nice follow through on a different time frame, they might be a really nice strong move. All right. So one suggestion for screener, if I want to remove symbols from the list of 40, there is no option to remove the symbols. So there is an option, the only option is to reset, right? So as an example, if I bring in the screener, right? So this is what you have to do. So let's assume that I've given some symbols, right? I'll click on OK. So now you can see the screener, let it load at least once. Can you see it is giving me some results? Now, if I have to remove, I can go to defaults and I can say reset settings. And once you do reset settings, and now you will see all those symbols are gone, and then you can add those symbols again, right? So that's the way to do it. So here you have reset settings, click on OK, and those symbols will be removed, and you can again start fresh. All right, so only we can replace. No, I just showed you, you can remove. What if I want to remove? So I just answered that, how to remove, but you can't remove individually. So once you have added something, let's say this I can only replace, I can't remove it. But if you have to remove all of them, then the only way is to reset settings. All right, so that answers your query. Voice is not audible much, nobody else gave that feedback. So if I just you just want to double check with other people, is the audio okay, or are you people facing some challenges with the audio? Because I just got a message in the chat box which says the voice is not audible. Okay, so few of you are saying that the audio is good. So uh, Namash, the audio challenge probably would be at your end, because you can see I've just taken feedback from other people. They are saying the audio is working fine. All right, perfect, great. So that brings us to the end of today's session, and that is what I wanted, that these sessions should be somewhere around 30 minutes, and that is why you can see we made some of the steps very short today, so that we can cover these examples even faster, because I know at times taking out 45 minutes, 50 minutes, or 1 hour can be a little bit challenge, but keeping it close to 30 minutes, it can be easier for everyone to quickly go through and watch these sessions. So again, thank you so much for joining in, and I will be seeing you now next weekend. Till then, stay safe, enjoy your Saturday, take care, bye bye.